Welcome into the reaction channel, folks. We have stocks exploding all over the place. Some very nice moves out there. We're going to talk stocks here at the top of the video. Kind of share some perspectives, opinions on what I like, what I see out there, what opportunities I see, things that might not be going so well. We'll speak about all that in this video here at the top. Then I want to react to three little clips here in this one. Ed Denny went on CNBC a couple hours ago. Looking forward to reacting to this video on where he thinks this market's going. Looking forward to reacting to this one from this analyst speaking about Ulta Beauty and having a reacceleration of growth in 2025. This is very important, even if you don't care about Ulta stock, but let's say you own ELF stock or own EL stock or any stock that, you know, sells makeup related products, beauty products. Very important one to react to there, so we're gonna react to that one. And then I want to react to this one for anybody that cares about Amazon stock, which I certainly do. Margin Story is the biggest support for Amazon. So yeah, we got a bunch of stocks to talk about, SoFi, Palantir, all those sorts of stocks, and then we'll react to these, okay? Appreciate everybody joining me as always. By the way, I hope everybody had a tremendous Thanksgiving. I hope you really enjoyed it with your family, everybody that was out there celebrating yesterday. I certainly had a great, nice relaxing day with my family. So now it's Black Friday, man, and now it's all about the deals and the sales, and we got our big deal going on for a few more hours here. Pin comment down there for 1000xstocks.com. We have two options. One is to save $30 a month. The other is to save $800 over 2 years. If you're looking for a 2-year membership, 1000x. Once again, for 1000x, that goes into all the different metrics you need to know on these stocks. The ability to compare 3 companies versus each other and just type in whatever ticker symbols you want and basically compare 3 companies on all these different metrics to try to figure out which stock is the best deal of the bunch to buy. We have our earnings call feature, our SEC filing, so you can just type in any ticker symbol and listen to an earnings call. Same thing with get SEC filing, see what insiders are doing. Our projections, which is arguably my favorite feature personally, being able to run projections on a stock, type in any ticker symbol, and then play around with the numbers on kind of what I'm expecting for revenue growth, net income growth, what a P should be for that stock, right? And kind of seeing what the compounding annual growth is. We have our financials, we have our charts feature, which is just looking absolutely magnificent now at this point in time. And not only do we have all that, but for a lot of you guys that are, let's say, more beginners in the market in your first year or two, the section that's going to help you out tremendously is this education section right here. And metrics will help you out as well if you're having trouble understanding anything that is talked about on the, on 1000x stocks, right? But this section is going to help you out tremendously on all these different subjects. If you need help understanding income statements, balance sheets, cash flows, performance SWOT analysis, right? How to value stocks properly. Not a lot of people even know how to value a dividend stock properly, a growth stock. I go into all that running a portfolio. So once again, pin comment down there to get that sale before it ends here in the next few hours. Alrighty, guys. So hope you're making some money out there because there's a lot of money to be made. Here we go. So Fubo making a nice finally pop. I mean, that one's been just lagging. We're looking for Fubo to finally, get moving. I mean, that stock's just been very disappointing. The business model, everything's getting better. The subscriber numbers, revenue numbers, the losses are coming down. The margins are increasing. Everything's going the way we want it to go. The legal front, everything's going. It's just the stock hasn't reacted. So hopefully this one starts to, let's call it come to life. Wynn Resorts trading at 94 right now. That stock is still a buy. Shopify, people are asking about Shopify stock. This is my biggest position in the Patreon portfolio. I do not own any shares in the public account because yesterday I did a video on the main channel called Financial Education, if you guys don't follow me on there. And I looked at the entire public account and went through all the stocks, and people were wondering, why don't I own Shopify in that particular portfolio? Honestly, I just haven't had a chance to buy it in that portfolio. But as far as a Patreon portfolio, it is my biggest position. I feel very comfortable with that one. It's had a good year, 57%, but really it's had a great last 6 months. Like if you pull up a 6-month chart of this baby, it's up 99% in the past 6 months specifically, right? Tesla continues to move, but it's having trouble like going over 350 and staying over 350. A stock that's having no trouble is SoFi. Look at this baby, up 123% now in the past year. There's another one in the past 3 months specifically. It's just moved crazy, 104% in the past 3 months. Insane, 139% in the past 6 months. What a past 6 months it's been for SoFi, right? This one just continues to see momentum. It just benefits. Like if the Russell goes up, SoFi's likely rolling. Even though SoFi's not really a Russell 2000 type stock, it's just kind of gets put in that category. If retail investors are feeling good, they buy SoFi. So like it almost doesn't matter what you have happen, but SoFi just benefits. Cake has now crossed $50 and continues to move, and it honestly still a buy. That's the thing with Cake. It doesn't matter. The stock could go to $60 or even $70, and it's still a buy. And that's the thing I love about cake. Like, I can continue to buy this stock even as it goes up. And I don't always feel like that in regards to stock. Sometimes there's like a stock out there that I'll buy, but I'm like, if it goes up 10, 20%, I'm going to lay back on buying. Cake's not one of those. Like, you know, I wish I could get shares at 30, but I can't. And 50 is still a steal deal in regards to Cheesecake Factory. Like, the valuation multiple in regards to Cheesecake, given the growth rates, like, this is still a steal deal. So let's go ahead. Let's pull up the search feature here, and you guys will be able to see what I'm talking about in regards to Cheesecake Factory. I think 1000X is working a little slow today because we got more users on the platform than we've ever had. That's for dang sure because of the big sale here today. So Cheesecake, looking at a forward P of under 14 on this stock. I mean, for the growth that Cheesecakes has over the coming years, a forward P of under 14, like, come on, man. That's like stealing money. So, yeah, Cheesecake sets up very well here. Elf looks like it wants to go over 130 again. This one still has a long comeback to go. I wouldn't be surprised if at this time next year, Elf's back over 200 again. They already got through all that muddy water crap that I told you guys was just a bunch of BS, but they got through that, and the CEO went on Kramer and explained that. Celsius, this one continues to obviously face that tax loss harvesting I told you guys they would face, right? But, you know, if you're a long-term investor and you have a long-term outlook, you know, certainly this is a pretty good opportunity there. Palantir just crossed 67, so I'm not doing anything in regards to Palantir right now. I'm waiting to see if it goes over 70, and then if it goes over 75. If it goes over 70 and then over 75, I might cash 1,000 or 2,000 shares in the public count that I have. But for now, when it's still in the 60s, I'm not making any moves right now, right? Meta is looking good. Honest continues to look very, very good. I mean, look at Honest's chart. It's a thing of beauty. It's a thing of beauty. Up 304% in the past year. And the move recently has been just straight up in a straight line. I mean, the numbers couldn't be better in terms of how fast this company's turned everything around. And it's just very exciting, right? So we've just got everything moving the way we want it to move. Amazon's looking good. That stock's likely going 250, 275 next year. AMD, I just obviously started a position there, so I like that. If we look at big tech here today, I mean, that's pretty dang good, right? Everything is green. Everything. I shouldn't say everything's green. Google and MU are slightly down, very slightly down, 0.2% and 0.4%. But outside of that, everything else in big tech's green. So that's looking real good. Commodities. As far as commodities go, GSG 21. I love it. 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 Oh, look at that. Basically, we've got no inflation in commodities in the past year. In the past year. Oh, that's a thing of beauty there. WTI is chilling at 68. Whew. I like that. That sets the consumer up very good for 2025. Very good. Very good. If we look at my possible buys watch list, it's a long one. Yeah, as far as my possible buys watch list, Fubo is obviously the big pop there. LVS, I've considered potentially making a position there. It's just like, it's hard to get me to buy LVS over Wynn, because Wynn's so much more diversified that I feel much safer investing in Wynn. Las Vegas Sands is just so heavy in Asia, because they're a Singapore property and the Macau properties, and they really have kind of sold out in North America now at this point in time. So, yeah, it's just hard to buy LVS. Like, I think it's an attractive buy. It's just, I have to go with Wynn in regards to that, right? And, you know, if we were to compare LVS versus Wynn versus MGM, I'll show you guys this. I think this is very important here. So let's go ahead, let's type in Wynn. Let's type in LVS, okay? And we're also going to type in MGM, which those are really the only three investable gaming companies that are international type companies, right? So what you're going to see here is Wynn's kind of middle of the pack in regards to forward P, but the difference is Wynn, I think Wynn has huge advantages over LVS and MGM. One, Wynn's much more diversified. They have properties in North America, they have properties in Asia, and additionally they're building a property in the Middle East right now, which is an incredible opportunity there, and they basically are going to have a monopoly on the Middle East market for at least the next few years, right, once that property opens. LVS is just a straight bet on Macau in Asia, right, in Singapore, and that, so it's attractive, but it's not as attractive, right? It comes with more risk. In MGM, I just don't really like where they fit in the marketplace, because you look at Wynn, they really cater to the highest high end. They're really catering to the top 1%. MGM, on the other hand, is, you know, really counting on the mass market. And for that reason, I don't really like MGM as a play. I'd much rather cater to the people that are going to drop $100,000 on gaming, or several hundred thousand, or $1 million in a weekend, right? I'd much rather cater to that market and be invested in that sort of company than the ones that are counting on people coming to Vegas or Macau and maybe spending a few $100, right? All right, let's react to some videos.
Ed, happy Black Friday. Great to have you.
Thank you.
You've been writing a lot, obviously, lately about the coming year, and actually the next few years. I know we've talked a lot about your 7K target, your 10K target down the road. To Sarah's point about the market broadening, is that, I guess, healthy on a net basis?
Absolutely. You remember when this bull market got started, it was kind of like the Rodney Dangerfield of bull markets. It got no respect because it was so narrow. And we argued that give it some time, it'll broaden, and that's what it's doing now. And we've certainly seen the SMID caps go on fire, and then the S&P 493, I think, are going to do well, increasingly well.
What do you think's going on with these yields? Are bond vigilantes convinced that there will be constructive work done in this administration?
Yeah, absolutely. I think the Trump administration, incoming administration, bought some time, kind of placated the bond vigilantes by basically acknowledging that we've got a problem with the deficit, and the new incoming Treasury Secretary is somebody who's got a lot of market experience, so he's kind of like one of us, if you will, when the market looks at this administration. And the fact that they're, in fact, going to go after spending and that they're going to try to raise some revenues, maybe with an across-the-board tariffs, at least shows that they're cognizant of the problem. And maybe they're kind of having a Bill Clinton moment. Remember when Bill Clinton was warned by his advisors, don't mess with the bond vigilantes. And we actually had a very conservative fiscal policy back then.
Well, I mean, analogs to the mid-'90s are pretty positive, and there has been some work done looking at what happens when you bring the budget deficit relative to GDP lower. It's an everything rally, is it not?
It becomes an everything rally, and the only risk is that it becomes too much of a good thing, that it becomes a melt-up. And we're kind of on the edge there, right? We've got the valuation multiples, which are quite elevated. We've got the forward PE around 22. We've got the Buffett ratio around 2.8, which is a record high. We've got Warren Buffett himself raising a lot of cash, which kind of has everybody somewhat concerned. But all in all, I think the bull market is still very much here and continues into the next year. And I don't see a recession. Recessions are usually caused by credit crunches, and that's not happening with the Fed inclined to lower interest rates. It's not happening with the price of oil unable to have a rally with geopolitical risks, which seem to be actually narrowing. So the only thing left to worry about, I think, is tariffs.
If you're wondering when's the next crash in the stock market, I'll tell you exactly when the next crash in the stock market is. And I think I spoke about this on the main channel on financial education recently. But the next crash in the stock market will transpire when we're going through the next wave of inflation. And I don't know when that is. Maybe that's a year from now. Maybe it's 9 months from now. Maybe it's 2 years from now. Maybe it's 3 years from now. That's when the next market crash is going to happen. Because unless there's some sort of black swan event, right? WW3 starts, like, that's all, a whole different ball game there, right? If some freak thing happens. But I'm just talking about, like, not a freak situation, but just like normal business cycle. When's the next market crash? When we get that next inflation cycle where all of a sudden CPI goes to 4, 5, 6%. It doesn't have to go to 9% where it went, obviously, in the 2022 cycle, right? And so if we get into that a year from now, 2 years from now, it'll be devastating to the market because the consumer will get slapped again, right? The consumer's finally getting in a healthier place again. But then if that next one comes in, the next one will be much more devastating because we don't have the sort of job openings going into the next inflationary cycle like we had going into this inflationary cycle. Because the great thing with this inflationary cycle and why it didn't devastate the economy and didn't devastate the stock market, because we had such a crazy amount of job openings going into this one, like by far and away record highs in history. Like you could see 2021, the amount of job openings was astronomically high, right? But the next time we're not going to have that sort of job openings going in, right? Which means if people lose jobs in the next one, they're going to have trouble finding jobs, and that's really what hurts the economy very bad. And you could have an extremely weak stock market for 1 to 3 years. if it could be a 2-year drag down for the market at that particular time. So when that happens, get scared, get worried. For now, it's kind of party on right now. You got big tech spending, obviously big tech looks great, right? Great setup for next year. You got the consumer getting in a much better place for 2025 because inflation's so low and real wages are picking up significantly. So for right now, it's kind of party on. But I'm telling you, whenever the time comes and we have that next inflationary cycle, that's when it's going to be night, and that's when it's going to be time to really look at some puts and make a lot of money on the downside.
And right now, it looks like they are being effectively used for negotiating purposes.
I mean, there's been so many flows into U.S. equities because of all these reasons we're talking about. EPFR reported $141 billion into U.S. equities,
huge,
and that's for the month, the heaviest inflows in a 4-week period on record. So do you want to just continue that trend, or do you want to go somewhere contrarian like Europe, where everybody hates right now?
Well, you're asking the wrong person. I've been recommending stay home versus go global since 2010. I've been recommending overweighting the U.S., and it's been on fire recently. But you're right, from a contrarian perspective, maybe it's worthwhile looking overseas a little bit. But no, I'm going to recommend continuing to stay home and invest. By the way, I don't like what you just said, because that's talk about contrary indicators. When foreigners really discover the U.S., that can be a contrary indicator. But that doesn't necessarily mean you want to go overseas. So, look, I'm not ruling out the possibility that we'll have some sort of pullback. I think it's Mike Santoli's favorite phrase. I like it better than corrections and bear market. So we could have a pullback, obviously, maybe in the new year. But right now, we're still got a Santa Claus rally, in my opinion.
You don't want to buy international stocks. I'll tell you the best way to play it, okay? But the reason you don't want to buy international stocks and try to buy international indexes and those sorts of things, right, is the U.S. has issues, right? Like sure, we got issues. Other countries have way more issues, and it's not even close. So to think like I'm going to outsmart the system because this particular stock market is trading cheaper on a P basis or whatever than the U.S. market, don't play that game. That's just a losing strategy. That's like this equivalent of saying like Ford and GM stock trade cheap, so I'm going to buy those stocks. Okay, yeah, do that and you're going to have lost money over the past 20, 30 years. Like, it's just not the play, right? The much more intelligent way to play it, if you want international exposure, here's what you do. What you do is you buy companies that have direct exposure, US-based companies that have direct exposure to other particular countries and markets. So let's say, for instance, you're really bullish on China over the next 10, 20 years, right? Look at a stock like Wynn in that situation, because I can tell you, with Wynn's properties in Macau, you could also look at a property like LVS, right, Las Vegas Sands. They have multiple properties in Macau. If China's going to do great over the next many years, guess what? They're going to go to Macau and they're going to spend a lot of money, right? And so you can get exposure to China through other plays. And there's a lot of other companies. Nike, if you want exposure to China, buy Nike stock. Nike gets a significant amount of their business from where? From China, right? If you want exposure to India, look at companies that are expanding their business rapidly in India right now, right? That's the way you can do it. And there's US companies doing that, right? And so that's a much more intelligent way to play it than saying, I'm going to buy an index that's an international index. No. Buy the best quality US companies that do business overseas, right? And there's some Canadian companies you can look at as well. I think Shopify is a perfect example of one of those sorts of companies that you can find an opportunity there. But for the most part, don't mess with the other countries' indexes. They're going to be ultimately a waste of time. And you can say, well, they trade cheap. They always trade cheap. That's just how it is. Like, all those indexes almost always trade cheap. They almost always look like a deal versus the U.S. market, and yet they perform horrible over time. And you just end up looking back and like, why did I waste all this money on this particular index? I thought I was going to outsmart the system and then no.
Holiday shopping expectations. So why do you think those will be the big winners this holiday season?
Well, first, we think overall holiday shopping is going to be fun. It's going to be a good holiday. The consumer has a job. Household balance sheets are in decent position. And the consumer is excited that the election is behind us. So that's going to help with consumer confidence. Why do we think those are retailers that are going to win during this holiday season? Either because they are gaining a disproportionate amount of market share, or they're in categories that stand to gain from good spending around the holidays. Those are going to be outsized beneficiaries of what should be a decent holiday.
What about Dick's? I mean, Dick's had a pretty good quarter, I thought, and the stock sold off, and it's not performing as well.
Dick's didn't report on the right day. That was a day where there was a lot of noise about the tariffs, and that overshadowed what was a very good result and an indication that it is gaining market share and managing its P&L very well. That's going to propel it as we move into 2025.
What about Ulta as well? That's sort of been a more controversial name.
It has.
Had such a tailwind for a while, but lately it's been a little choppier. Why do you still like it?
It has been choppy.
By the way, you guys know from time to time I like some retail stocks, right? Which I actually don't like that many nowadays. It's a tough space. But do I like DKS? And the answer to that is it's okay, but I don't really like it that much. A stock I would much rather buy over that one is Amazon. Amazon. Like at the end of the day, pretty much all the same stuff DKS will sell, Amazon sells, right? And so I'd much rather just own that directly. Or I could own Nike directly, which keep in mind a lot of the product that's in DKS is Nike product, right? Or if you told me I had to buy a physical retailer, I would, you know who I'd actually like to buy over DKS? I would actually rather buy Foot Locker. I would much rather buy FL Foot Locker stock if I had to buy a physical retailer. Like, if you force me in that situation, but there's too many other direct plays. FL would be interesting to me if it wasn't Nike, if Nike wasn't trading in the 70s right now. But, I'd much rather just own Nike directly than try to play it through Foot Locker.
There's been a lot of additions to the category. Sephora has moved into one of the main department stores. We are in the belief that next year the drag from that will become less pronounced, and that will allow Ulta to flourish. It is an inexpensive stock that stands to re-accelerate in 2025. The pace of change is going to work in the benefit of those who are along this name.
So let's see where Ulta's trading at here. I'm kind of interested to see Ulta and where this baby's at. So Ulta forward P of, we can call it 16, 17 range here. Ooh, next year earnings per share might actually be down for the company while revenue could be up slightly for Ulta. That's interesting. So, at the end of the day, I would just much rather, instead of buying Ulta, the stocks to buy in that space, much better stocks to buy, ELF and EL. It's just so much simpler. And, if somebody wanted to buy those two stocks, they could do a strategy similar to what I'm doing with Celsius and Monster right now, where for every, $2 is going into one, $1 could go into another, right? So let's say, I didn't have a position in ELF and Estee Lauder and I wanted to start a position, I could put $2 in ELF for every $1 I put into Estee Lauder, right? And I'd much rather have exposure there. I get the major growth with ELF, right? And then I get the major turnaround story with Estee Lauder. And so I think that's just a perfect combo there. And I think both those stocks will significantly outperform Ulta over the next 2 years, 4 years, 6 years, just to be quite frank.
Does print concern you at all about broader trends?
I think Best Buy's print shows that spending right now is very episodic. So the consumer was waiting in October till deals came out in November. And we saw evidence of that their sales in November so far are up 5%. The consumer's getting smart and sophisticated, shopping around these key events like Black Friday. And then what's going to happen is there's going to be a drop-off in the days following this weekend. And then the consumer's going to re-engage as we get closer to Christmas. So it doesn't surprise me the cadence of what Best Buy talked about, and I think that's becoming more and more the norm.
Another stock I'd much rather own than Ulta is, guess who? Amazon. At the end of the day, many of the same products that Ulta sells, Amazon sells. And as soon as you get a customer to get used to ordering Amazon for those beauty products, I think it's going to be hard for Ulta to get that back because the convenience factor of just being sent to your house in hours or a day or whatever, right? And once you get used to just ordering those cosmetics through Amazon, I think it's going to be hard for Ulta to get those customers back. And speaking about Amazon, let's talk Amazon.
Apple and Amazon. Let's start off talking about those. You know, it's funny, Barton, I'm reading some of your notes about Amazon. They're ramping investment in Anthropic that might help the optics, giving them a big LLM to run on their services. Empty calories, you say, though, self-funded revenue lift. You also go on to say that there's some obvious weakness there as well. So I guess you don't sound like a man who loves Amazon, even though you have a buy on it.
You know, I have a buy on it. The stock has done, decently. And, it's a large company with its arms in a lot of places. And I think on balance, you should own Amazon. I do think that AWS has not really been accelerated by AI, but that could happen.
Yeah.
Probably will happen. They have been.
That's a 2025, 2026, 2027, 2028, 2029, 2030 story.
Losing share in AI, I think, to Azure and to Google. But I think that can improve as they improve their capabilities. The biggest kind of support for Amazon right now has been this tremendous margin story. So it's almost like whatever happens on the top line, the margins have been so strong that it's an incredibly powerful, compelling element to that story, and that almost outweighs the rest of it.
Yeah. The reason we think of Amazon, at least at this time, is, of course, because of e-commerce. Does it even matter anymore? Does this holiday period, does it still move the needle for Amazon? And is it of importance?
It's very interesting. Amazon has, we believe, decelerated to a place in e-commerce of growth basically in line with industry averages. The fastest growth in e-commerce from scale player would be Walmart right now. And Amazon's not growing as fast as Walmart right now. So, at one level that could be concerning, but the margin expansion has been so powerful that it's hard to really worry too much about that. And e-commerce is still outgrowing, by a few percentage points overall commerce. So it's still a growth story. And then you have these new elements factored in on top of that with advertising, right at the forefront. So that's enough, we think, to keep Amazon interesting and to make its stock one that you want to own on a relative basis at this moment.
What about Apple as a holiday shopping?
Oh, come on. So I just ran some projections here on Amazon that I think are pretty fair. Next year, or 2025, I think revenue growth will be about 14% roughly. I don't think that's a crazy number at all. Net income growth, I have them doing around 25% net income growth in 2025. Then after that, I have them doing on average 12% revenue growth per year and 20% net income growth. The bottom line should increase much more rapidly over the next, I would say, 5-10 years than the top line basically increases, because they've got a lot of their major out of control spend done nowadays. And so the story's really around earnings per share growth, in my opinion, from 2025 to 2035 versus revenue growth like it was in the Jeff Bezos era, right? Where it's just revenue. So, you could value the stock anywhere between about a 35 PE and a 55 PE given the growth rates, and it's Amazon. And so 35 to 55 is fair. So if you buy the stock today, right, at 207 even, the compound annual growth rate on the low end under my scenario here is about 17%, on the high end about 31%. That's pretty darn attractive, okay? Appreciate you guys joining me as always. Thanks so much for being here. A few hours left on the Black Friday sale. Once it is over, it's over. So if you're watching this video tomorrow, the deal will already be over. Hope you guys really enjoy that. Hope you love 1000X as so many folks do, and I appreciate you all for joining me as always. There will be pinned comment down there to get the deal right before it ends. Much love and have a great day.